Hi, this is Brien Lundin, and you're watching Market 1 Minute. I'm here with a longtime friend of mine, Rick Rule, chairman of Sprott USA. Rick, you are the Elvis of the resource investing industry. Everybody wants to know what you're buying, when, where, and how. I've followed your career over the years. Rarely have you been as excited about the market as you are right now.
I think that's accurate, Brian, and we could talk about a whole bunch of different aspects of the market. But here in Vancouver, I think you have to talk about the resource juniors.
Right.
You know and I know that the resource juniors are off 83% in nominal terms and 90% in real terms, which arithmetically means that they are 90% cheaper and 90% more attractive than they were in 2010, 2011 when everybody was aggressive. It's odd that people's expectation of the future in bull markets is so bullish when the market is risky, and people's expectation of the future in bear markets is negative when the market has so much less risk. The point that you have to, what you have to do to be a successful resource investor is take the backside of that trade.
Right, and you know, you're famous for being a value investor in what must be the most speculative of all investment markets. And the key to that is recognition that this market moves in very clear cycles and having the patience to sell at the top and more importantly buy at the bottom. You're buying right now.
That's absolutely correct. Now in fairness, Brian, as I had done in other cycles, I began buying too early. That's the hallmark of a linear thinker. But the truth is, when a market goes up by 500% or 1,000%, the rent that you receive on your investments is such that buying early doesn't become such a sin. And this is precisely that type of time.
Well, you've always said that the turn in the markets may be inevitable, but it may not necessarily be imminent. So you're known for being a bit early at times. The gold market right now, we've looked at it and you and I have had these discussions and it just seems like we're around the bottom in the market. We don't know when the turn will come, but if you're looking for value, if you're looking for opportunities, this has got to be right about where you want to be taking action. Without
being pandering, Brian, my aha moment was at your conference in New Orleans, listening to Alan Greenspan, listening to the architect, if you will, of the sort of strong dollar fraud that we've lived through, and listening to him say that the $4 trillion added to the Fed balance sheet wasn't inflation, it was only tinder. Listening to Greenspan discuss the edifice that he created in the context of what he expected, which was, quote, gold price higher, interest rates higher, was the catalyst for me to recognize that the suppositions that I had were true and that timing was less important than tactic.
And you know, you can say a lot about Alan Greenspan. He was one of the most radical of all gold bugs in the 1960s. Then he ended up within the system pulling the levers of the economy. But he's smart, and he still harkens back to those same fundamental principles, and he actually told us at the conference and in private conversation that a rise in gold is inevitable because we have to reconcile this tremendous money printing.
I think that's right, and I think going back to your earlier question, will it happen in 2015? I think so. If it happens in 2016, does 12 months matter against 4,000 years of monetary history? Not from my point of view.
Because the types of gains we're looking at in this market are so great that we're looking at when you buy and what price you buy, although you're a good buyer, may be less significant of just getting in the market at generally low levels.
I think that's right, and I think the sentiment question that you asked me is important. I remember at your conference in 2000 having to give a speech called A Case for Gold. I had to defend to the crowd that there was a case, not the case, just that there was a case for gold. And as I recall at that point in time, gold was about $275 an ounce. People who assumed that there was a case for gold did very well in the ensuing decade. But it's interesting to note that the sentiment at bear market bottoms is always the same, now as then.
You know, when I look to find value investments at this low point in the markets for my readers, one of the things that really sticks out is Sprott itself. Tremendously leveraged because of its holdings in a lot of these companies and warrant holdings, tremendously leveraged to a rise in the metals in the market itself.
Well, it's kind of you to say that. We have held steady in assets from 2011 till today. which doesn't feel like an accomplishment until you look at our competitors,
Right.
many of whom don't exist anymore.
Right.
We've worked very hard to become a brand for resource investing. And by the way, non-resource investing. We have some very, very good managers in Sprott who are not resource oriented at all, although they have the same economic outlook than we do. And amazingly, focusing on a market that's down 83% in real terms, we have $345 million in working capital and generate free cash. So we've done a good job in a very bear market. More importantly, I think we are positioned for the inevitable rebound, probably better than any competitor we might have on the planet.
Well, I think it represents a tremendous risk-reward dynamic for investors right now. Rick, thanks a lot for being here. Wonderful insights as usual. A great pleasure to have you.
Brian, always a pleasure.
Thank you.